And despite doing the best due diligence you can, it's hard for even a building inspector to see through walls, to climb into every cavity inside a home. And there are some crazy statistics out there and many horror stories when it comes to people still doing due diligence on real estate, but getting stuck with properties and houses riddled with problems. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, Code Cracker, we're going to dig into investing. We're going to have a good lesson around how do we approach investment by making some real estate decisions about what is known and, of course, the unknown in real estate. There's always a lot of unknowns, and, of course, we don't want to end up a statistic, a victim of the unknown. The more we can control real estate, the more we can safeguard our investment decisions, the better off we're going to be. No one wants to be a gambler. No one wants to have a 50-50 bet on real estate. So how can we de-risk our situation to the best of our ability? Real estate investment is not risk-free, but we can certainly take some steps to understand how to manage risk. And of course, for a lot of property investors, they always end up failing at property investment. Lots of them. In fact, there's statistics out there that the average property investor owns real estate for circa 7 years and then stops and then moves on to something else. Why can't property investors go the distance? Perhaps it has a lot to do with how property investors fail to acknowledge risk when entering a real estate deal. Today's show, we're going to factor risk. Yes, it could be called risk factor, not X factor, but risk factor could be the title of today's show. But hey, welcome back, regulars. You know the drill. Play the program in double speed, get your life back. All the episodes I've done are lessons on real estate. And a big part of my job is simply sharing information on real estate investment. So welcome if it's your first time tuning in. Wow, you've found real estate gold. We never know if it's going to be a good episode until we get to the end. And of course, if you want to read some of my work, feel free to get The Australian Property Game. It's a book on Amazon, and it'll rock your boat. You'll never look at real estate again the same once you read the cheeky book. But hey, let's do it. Let's talk about known and the unknown, investment and real estate decisions. That's today's show. Now, to understand real estate, you've got to understand real estate is typically reliable. People are not reliable. And because people are not reliable, the way they view real estate, the lens they view real estate from is often around perceived gains rather than perceived losses. And of course, that can, people are a half glass full, not a half glass empty when it comes to their viewpoints on real estate, which is great. But we do need to factor in how to mitigate risk. Now, if I was to guarantee you $50,000, you've guaranteed $50,000 as option one. And option two, you could get 80% chance of gaining $57,000 and a 20% chance of getting nothing. What option are you going to take? You're going to take option one, being $50,000 guaranteed, or you're going to take 80% of $57,000, or you have a 20% chance of losing it all. Which option would give you the best chance to maximize your profits? Most people will choose option one, the safe and sound $50,000. But actually, if you chose option 2, and I'm just playing with you here, you would have made 55,600. Option 2 actually was a higher rate of return, but factored in its risk, and ultimately, mathematically, was a better and more correct answer. So prospect theory is the theory that people base perceived gains rather than factor in also losses. And things look great on the surface is the point of the lesson between option 1 and option 2. And when investors look at real estate, they look at it through the lens of gains. So typical real estate, you can go on realestate.com and you can see real estate out and about. It can be more modern. It could be much older. And when people are looking at it, they are quite often looking at it through rose-colored glasses. And there are some interesting examples of people looking at real estate through rose-colored glasses and it coming back to bite them because the real estate investor has not factored in risk. Now, there's an interesting one right now in Australian real estate, 100 Commercial Road, South Yarra, great suburb, nice little pocket of the world, right near some of the best parks in Melbourne. But this poor old building got approved by local council sort of 25, 30, 40 years ago. And some dodgy stuff went down and the owners are left with a pretty sizable $24 million repair bill. And the interesting thing, though, is despite this problem dating back multi-decades, there has been sales of real estate in this building to people who have not realized the building is full of huge, huge, huge costs and repairs. And so this stuff is very, very common. People look at the established market, think it's safe and sound because it's built, because it's standing, because it exists, and then find themselves in all sorts of bother because the properties themselves are problematic. And this one's just a great example. You know, someone bought one of the apartments there just 2 years ago for $409,000. And today that same apartment is now dropped in value. It actually would not be sellable now. News has broken that the apartment building needs $24 million in repairs. So here's the long and the short of it. When we're looking at real estate, we need to factor in risk. And really, we can look at real estate through the known lens and the unknown lens when it comes to how we decide to form a strategy with real estate. 70% of households have reported building problems in Australia. So around 70% of our urban housing has issues with it. And that's a statistic from the Australian Housing and Urban Institute. And despite doing the best due diligence you can, it's hard for even a building inspector to see through walls, to climb into every cavity inside a home. And there are some crazy statistics out there and many horror stories when it comes to people still doing due diligence on real estate, but getting stuck with properties and houses riddled with problems. And so it really brings us to a metric around how do we assess risk when buying real estate? And really, we have to also sort of go through a concept known as short-termism, which is really the bias captures the preference of short-term results over long-term stability. And really, short-term preferences is just getting emotionally connected to a property over the couple of weeks you look at real estate, really not factoring in much more than you like the look of the real estate, you like the look of the suburb, and you will buy the real estate even with its trade-offs, and buy the real estate perhaps not knowing the full extent of the problems with the real estate. And this is where we have to also define what is actually long-term. How do we define long-term value in real estate? And I define it as such: sustainability of time. Real estate investment is really about time. How long can we go for? True long-term value is not about finding the lowest price on the day of purchase. It's just not. Plenty of properties have perceived value online the day you want to buy. They can be cheaper than properties that you pass up on. They can be they can look prettier in photography. Real estate agents are pretty good at that these days than the properties that you decide not to buy. And all of a sudden, you can end up buying a market lemon. So true long-term value is not about finding the lowest price point property on the day. It's about selecting a real estate asset that can weather market shifts, regulatory changes, and the demographic cycle, while providing a stronger holding cost structure. That's really what this is about. That strong holding cost structure allows sustainability of costs and allows you to remain invested in the market. It allows you time in the market, which ultimately is how wealth is created from property investment. So when you think about it, like the statistics are pretty crazy. People hold on to real estate for circa 7 years, which isn't very long as a property investor. And some people, do very, very well in a short period of time, but long-term property investment is over 20 plus years. When you meet people who've owned real estate for over 20 plus years, they are pretty happy. When you meet people who have owned real estate for 5, 6, 7 years, sure, they may have made a few bucks, but it ain't life-changing. And so sustainability of time versus short-termism is a really critical nexus point to understanding risk, because we have to define what we're trying to do. What we're trying to do is hold real estate for a very, very long time. And of course, when it comes to the idea of real estate, we obviously have a probability of success and a probability of failure. And really, we have to ask ourselves, what are the chances of success versus failure based on whether the property itself and its hidden cost are sustainable over time? Now, what do I mean by hidden costs? Well, obviously, going back to the South Yarra example, there was a hidden cost of $24 million in that real estate. So we need to use a methodology to determine probability of the unknown, And we can use the Kelly equation, or the Kelly Criterion, which is just basically the law of probability. The Kelly factor, or the Kelly criteria, if you like, is a probability of success. It's an economic kind of principle. And it says basically that you can never determine the full extent of a problem. So you have to factor in the probability of failure. The probability of failure in established real estate is around 30%, which is basically the Kelly criteria. The probability of success is 70%. The Kelly criteria, if you like, has 5 sections to it. You've got to define what you're doing. You've got to estimate the outcome. Then you have to apply a formula of loss, the probability of failure being 30%. Then you need to decide if you're going to do what you want to do and deploy your capital. And then you've got to implement what you're trying to do into a portfolio. That's really the funnel, if you like, when it comes to the Kelly factor or the Kelly criteria. It's a probability of basically the gamble of real estate. And though, most people wouldn't say real estate investment is gambling, there is always a proportion of risk with any investment that you do. So there is a probability of failure. And I guess if you think through the Kelly criterion around the first section of the funnel, define the deal. Defining the deal, you really have two choices in Australian real estate. You've got established real estate and you've got new real estate. And so understanding that, you're really defining what is known as asset risk, the asset risk. And so if we were to look at a brand new property and we were going to look at the cost structure and the viability over the first 10 years of the cost of that real estate having a problem, we can look at the estimated outcomes of a brand new property having a cost problem. What are the chances of success versus failure based on the Kelly criterion of whether the property's holding cost is sustainable over time, over 10 years? We're putting 10 years on this. And really, when you look at new real estate, there are some risk advantages in dollars for new real estate. What are the risk advantages in dollars for new real estate? Well, typically you get a stamp duty deduction with a lot of new real estate today, which means you're already ahead, and you can put a, say, $20,000 reference on that. The initial defect period. So what that is handover. With older established properties, the day you buy them, the day you realized that you just bought a property and the real estate agent done a great job at masking up with a rug that you need new carpet in bedroom 3. The initial defect period or the initial handover period for new construction is covered by the builder. It's not covered by anyone when you buy a property, caveat emptor, buyer beware. When you own a new property, you're probably going to get a better caliber of tenant profile because generally more modern properties are advertised for rent at a higher rate than their equivalent older property. And of course, over a 10-year period, that's worth $20,000, around $2,000 per annum. A brand new piece of real estate gets extra depreciation, gets full depreciation. A more modern property doesn't get full depreciation, but it does well with depreciation. And really older property really doesn't get much depreciation, if any at all. The extra depreciation over a 10-year period for a new property, and this is comparing $750,000 new property versus an established property for $750,000. Over 10 years, you're going to get $143,000 risk advantage in real annuity coming back to you in the form of deductions from your new real estate. Lower maintenance, an older property would need to consider around $3,000 extra than an established property, than a new property. The 6-year structural guarantee, new properties, new houses, for example, get a 6-year structural guarantee. And effectively, that is underwritten by law. Now, that's worth something, because we saw that unfortunately that person buying that 40-year-old property in South Yarra has no structural guarantee, and it has a lot of structural faults with it. And structural faults are things like plumbing failures, electrical wiring failures. You need a new roof replacement. The piers on the home are, out of kilter. And all of this is structural. And when you do a building and pest inspection, you can quite often pick up some structural imperfections with real estate. One of the challenges with it is a lot of people have, for example, illegal structures on secondhand properties and structural imperfections on secondhand properties. And there's no mitigation. There's no one coming to pay for that. It's just you, the investor. So what is a structural guarantee worth for 6 years? Well, particularly when we're referencing the known versus unknown, you could factor $80,000 that is worth. Capital improvements. So when you buy a property that's older than 10 years, 15 years, you've got to factor in a capital improvement cost. That's brightening up the kitchen, brightening up the bathrooms, fixing some waterproofing, fixing some issues. And that in itself is circa $40,000. Obviously, a newer property is going to have less vacancy than an older property. People move out of older properties a lot more than they do newer properties. People will stay in newer properties a lot longer. And for example, I bought a property which was new in 2009, and it wasn't until 2021 that the tenant left. Why did the tenant leave? Because I actually had to ask them to leave because they couldn't afford the new amount of rent for that area. So modern properties, people will stay longer, and that is worth something over a 10-year period. If you had 1 month vacancy every 3 years in an older property compared to a limited vacancy in a new property, it's worth about $10,000 over a 10-year period. Generally, lower insurance premiums for new versus secondhand, generally lower issues with compliance and regulation upgrades because newer properties come compliant already. Now, we're seeing this with property management. Some of our much older stock, much older real estate, some of it, our property managers have had to say, look, it's no longer actually in keeping with the current legislation. Your property is now not reaching the minimum performance standards of what the market and the legislators are legislating. In other words, you need to go and retrofit some compliance into your property, and so factored in about $6,000 for that. Just lower tenant turnover, one fewer change. So obviously there's letting fees with tenant turnover. There's costs involved to pay people to find you a tenant. When it comes to resale, a more modern property 10 years later is a 10-year-old property. A 20-year-old property 10 years later is a 30-year-old property. And so the more modern property has future higher resale built into it because it's less old than the already old property. And again, like the more old you go, the tougher it is on resale because people start to realize, well, that 30-year-old property now, that's a 30-year-old kitchen. That's a 30-year-old roof. That's 30-year-old plumbing. That's 30-year-old flooring. That's old. And so people will look at it differently using the model of assessing risk. And of course, today, more modern real estate has thermal efficiency built in. Probably the big elephant in the room is, will government one day impose a carbon tax or a retrofitting tax on thermal efficiency of older real estate? And again, you have to factor what that could look like based on some pretty conservative estimates. It's around $65,000. So what is the total risk advantage of a more modern new property over a much older property that is established based on a 10-year journey using everything I just explained? Well, once you add it all up, it's $504,000. $504,000. Now, you may do your research on an established property and go, well, it's newly renovated, so you could get rid of capital improvement costs. You could maybe lower your tenant turnover letting fees. You could increase your depreciation. You could, factor in that when you buy the real estate, you want $20,000 held back for possible defects that you don't know about. You can do all sorts of things, but really what I'm alluding to here is there is a significant risk advantage by comprehending the known versus comprehending the unknown. Now, really, when we look at some older property, what are the chances of success versus failure based on whether the property's holding cost is sustainable over time is really the question we're trying to ask. Now, I was looking at buyer's agent. I know the buyer's agent, good human being, but very, very young, been in the industry 3 years, early 20s, probably doesn't have the lashes on the back like me from not knowing this stuff at this point. And I can see some of the deals that that buyer's agent is putting together, and I can see that they are not factoring in risk when it comes to holding costs. You can tell because the asset that the agent is choosing, it's pretty busted ass. And though its purchase price is sort of mid sixes and it's got a 6% return, you can see that that return is high because capital growth is not hitting the real estate very, very well because it's in Melbourne. And it's probably, you have to factor in some equations into this purchase. So remember, this is a $620,000 purchase. We know that when it comes to really, really bad real estate, you see, just terrible levels of capital growth. And probably when I look at this real estate, I can just see that the reason the rent's better than the purchase price is because the asset has risk associated to it. So if we were to factor a drag year in when it comes to real estate investment, if we took two 750,000 properties side by side, one's established, one's new, and you factored in all of the risks that I just talked about, from tenant turnover to lower insurance to needing some repairs and maintenance to maybe doing a renovation, you're going to have a drag year. Now, let's just assume that both the properties, the more modern property and the older property, have a 7% capital growth rate, but the more modern property doesn't have a drag year. It doesn't have a year sitting out of the market being retrofitted and repaired. After 10 years, the $750,000 newer property becomes a $1,475,000 property. because the older property had to sit out of the market for a year fixing itself, it goes from $750,000 to $1,381,000. That's a $93,000 difference in its performance because it's dragged back by problems, by costs. Now, the drag effect just means that both investments in 10 years' time end up in different mathematical places. The compound time, wealth equals assets plus return plus time. So factoring risk is really an important kind of concept here. And so we're going to use the Kelly Criterion, the Kelly criteria, if you like. And really what we're sort of explaining here is new builds don't really have capital cost improvement problems. They don't have holding cost problems. So you don't really need to factor in the Kelly criterion of a probability of failure of 30% for new real estate. The returns are cost structurally protected. So they're built into the deal. You're buying it when you look at the deal. With an established property, you have to factor in the unknown around costs. If we assume a 77% chance of success, a 30% chance of a loss, the worst case cost loss from that $504,000 I've explained drops to $151,000 or 30% of $504,000. All of those costs I read out before. Now remember, maybe some of those costs don't pertain to you, but you still need to factor in the Kelly criterion of 30%. And so just based on using all of those ones I explained, 30% is $151,000. So you can imagine that property, which I described as pretty run down, really you would have to factor in 151,000. So you're not really paying 620, you're paying 771 for that real estate, because you've got to factor in over 10 years, what is the cash flow going to look like and the cost base going to look like. Now, some people think 30% is too high and use a formula known as half Kelly or the half Kelly approach. And that really is the expectations that cost can be reduced further through, good negotiations and so forth. Nevertheless, even if you used half Kelly, that property which I explained before, you would need to factor in $76,500. But that's the gamble. That's the gamble. And this is where new real estate, the right new real estate, bought off the right people, bought off the right organizations, has with it a built-in protection mechanism. And really, that's effectively how you are deciding to use your capital. Now, remember, we've just applied the Kelly formula and gone through a funnel. We've defined the deal. What we're doing is when we define the deal, we're comparing new versus old. We're estimating the outcomes. We apply the Kelly formula, and now we decide on capital allocation. When we look at new real estate, we can decide to deploy real estate knowing that we've got statutory warranties, mandatory insurance, like how insurance on new builds, defect liability periods, and consumer guarantees. And it's all protected under legislation. The government has all sorts of legislation, from the Home Building Act to Home Building Compensation Fund to you name it. There's like Building Act 2004. It's all legislated. And so when you buy a new property, you're buying a legislated piece of something. When you're buying an established property, it's caveat emptor, buyer beware. There's two different versions. New real estate is not buyer beware. It's a lot different to that because of the legislation. Established real estate, it is what it is. It's buyer beware. Nothing wrong with it. You've just got to factor in and apply the Kelly formula when it comes to established real estate. So again, like deciding to deploy capital and asset risk. This is really the conversation. And I go, okay, well, new property is not buyer beware. It's got statutory warranties. Established properties, buyer beware. And in that example, really the Kelly Criterion is $151,000 that you need to be factored into your decision making. Now you might say, okay, well, I'm now factoring $151,000 on that $620,000 property. That means if you wanted to factor it in and pass it on to the vendor, you've got to pick up that asset for, $400 and something thousand. And so the probability of that also becomes very, very difficult. I don't think the vendor would care about your Kelly equation. But it's good you know about it now. It's good you know about it. And so you can try and negotiate that into your negotiations. But most people are ignorant. Most people don't know about the Kelly criteria. And so they just overpay for real estate and then end up over a 10-year journey dealing with the costs they never thought they would receive. They never thought they would get the renovation they didn't think they needed to do. And that's why a lot of people opt out of real estate. They move it on. They shuffle it on. And so you've got to decide how to deploy your capital. So now you've decided that you're either going to do an older property or a newer property. That's on you. You've got to implement it into your portfolio strategy. And what that means is you've got to hold the real estate. Now, buy and hold is two words. One is the buying, one is the holding. And so there is a stress metric when it comes to risk, when it comes to holding something. Now, many sort of behavioral sociologists believe that the probability of a loss lands between 5 and 25% before it breaks people. So if something carries a loss rate above 5 to 25%, it kind of breaks people. And so knowing that, at 25%, you're going to red line and break people. People aren't going to be mentally capable to go through the pain. And 5% is quite low, but I've met 5% people. They freak out that their letterbox, fell over. That the number on their front door, the Scrooges came out. That the ability to handle loss is so, they're so behavioral finance wise, so challenged by it, they struggle with real estate. Now, every real estate has a loss profile. That's as simple as that. And, you've got to land it under 25%. Otherwise, you will completely break people. You'll completely break them. So what is your stress metric when it comes to handling a loss? Can you handle the probability of a 15% downside ongoing cost loss? Can you handle the probability of a 30% downside ongoing costs, money coming out of your back pocket, lost over a 10-year period? But this is where loss needs to be added to a further metric. Could you actually handle a 15% cash flow loss coming out more than you expected to pay for real estate over a 10-year period, plus a 10% market downside correction in the market cycle? Or what about a 30% loss in cash flow plus a 20% loss market set downside? This is really the implementation, the holding phase of real estate. This is where we have to now think about a market risk, an adjustment for market risk. Remember, the market also carries risk. That's the reality of the market itself. Now, I'm on record, I've written a book about it, that, more cities that are bigger just have a lower risk profile, basically. Sydney's less risky than Broken Hill. Sydney's less risky than Bathurst. Sydney's less risky than Alice Springs. Sydney's less risky than Cairns. Melbourne is less risky than, Townsville. That's the reality of it. And so the bigger the city, the more diverse the economy, the more industries in the economy, the less risk for that marketplace. So I factor in, if you were to buy in Melbourne, the risk adjustment is 10%. It could go backwards 10%. Sydney could go backwards 10%. Geelong, it's a feeder city, could go backwards 10%. Broken Hill could go backwards 40%. And it could go backwards because the market goes down, or it could go backwards because it takes Broken Hill 40% longer to achieve its result compared to Melbourne or Geelong at 10%. So we've got to implement market risk. And of course, I teach there are cities with risk profiles. Global cities, Sydney and Melbourne, 10% risk adjustment. New world cities, Brisbane and Perth, 10% risk adjustment. Primate cities, Adelaide, Hobart, Canberra, 10% risk adjustment. Feeder cities, Geelong, Newcastle, Ballarat, etc., 10% risk adjustment. It's very, very low risk. But then you get into Bathurst and Tamworth, and it's 20% risk adjustment. Port Douglas, Moree, 30% risk adjustment. Broken Hill, dying towns, 40% risk adjustment. It's going to take you 40% longer to get a result, or if the market actually goes upside down, the market will drop by 40%. And so you've got to factor in market risk. So at a minimum, at any one time, at a minimum, even if you got the perfect asset, at a minimum, you're already starting with a 10% probability of a market cycle loss. If you were to buy in Sydney today, you're already starting at a 10% probability of a market cycle loss. However, that means Sydney's got a 90% probability of a market cycle gain. Melbourne's got a 90% probability of a market cycle gain. Geelong, 90% probability. Other markets, less probable. And the more you go into a smaller area, the less probability. Now, again, if the probability of behavioral finance wobbles, in other words, people getting so stressed out on real estate, if the loss lands between 5 and 25%, it breaks people. And you're already starting at a 10% loss. So guess what? That notion itself breaks people. They don't even become a property investor. They can't handle the fact that they could lose money if real estate went down in value. And real estate does go down in value. There are periods of time that real estate goes down in value. And again, for a lot of the younger buyers agents, which I, see because they're, probably more active on me than on social media and stuff, pretty good at that stuff, aren't they? They've actually, for the most of them, never seen a market that's actually made a loss. And, they've been blessed over the last couple of years. So markets do make losses. And so, again, if we implement market risk, asset risk into our portfolio, we can start to sort of think through this kind of stuff. And again, then we've got to take a consideration on risk of, if we do look at new real estate, we have to look at what is known as the CAPM algorithm, which is risk demands a premium. If you're going to do a strategy, that demands a premium in risk. Really, with new real estate, it's developer solvency, the builder execution, and time frame risk. And all of this can be mapped and, explained. And so if your delivery risk is 0%, delivery risk is at 5%, delivery risk is at 10% or 15%, there's a premium added to the price of real estate. And so again, we're looking at the implementation into a portfolio here of looking at real estate. Now, established property, really, there is no risk fee to it, because delivery, it's delivered, it's there. And so you don't have to factor in any risk, because the day you purchase it, it is already exists. It might be a good property, it might be a bad property, but the delivery of it, it is delivered. Then you can look at some of the more new strategies, new real estate strategy, a turnkey house and land. The execution and premium buffer you need is not very high, because fixed price contract, turnkey solution, so delivery risk is low, around 5%. If you're going to buy off a tier 1 developer using pre-construction, get them to build it for you, your delivery risk is very, very low. It's like 5%. Why? Because Fraser's Property Group is a great developer and got billions of dollars in the bank, and if they say you're going to get something, you're going to get something. Mirvac, the big private companies, the ARIA Property Group, these type of award-winning businesses deliver. You get what you pay for, and so you don't have to factor in much delivery risk. This is not to be confused with you, the human being. This is the real estate. You, the human being, may have your own financial circumstances. Everyone's financial circumstances are completely different. So it's about the delivery of the real estate. When you look at a custom design build, it's higher risk than a turnkey build, 7 to 10%. Buying pre-construction real estate off a no-name developer, very risky, 10 to 12%. Knockdown rebuild, much more risky than a turnkey land, 10 to 12%. Renovation and extension, very high uncertainty. It's got very high uncertainty, really about 15% delivery risk. What you think you're doing and what you end up doing is two different things, because you start with an idea and it grows when it comes to renovation. And so when it comes to delivery risk or strategy risk, you've got to factor that in as well. Now, again, like when we look at, investments, I like to call good investments all-weather investments. They can deal with risk, and that's really why I call it an all-weather strategy. So, I've handed over some pretty beautiful properties of late, and, when I look at the real estate from a market risk point of view, like a building I handed over in Wynnum, Brisbane, the market risk is 10%. The property cost risk adjustment, like you don't have to put a cent into that property for at least 20 years. So it has zero cost risk adjustment. However, the delivery risk was a pre-construction property. Did people get what they paid for because it was a tier 1 award-winning developer? The delivery risk was 5%. So all up, the human being is dealing with 15% risk in their strategy. Very, very, very low risk. 85% upside, 15% downside. Do you see how it works? Market risk, property cost risk, delivery risk. Again, I've got, just so many examples of all-weather investing whereby you buy in a safe market, you don't have future costs associated with your real estate, and then your delivery risk is really the only other thing you need to factor in, which you can de-risk by dealing with the right professionals in the industry. Market risk adjustment, property cost risk adjustment, delivery risk adjustment. A house and land package has a low delivery risk adjustment. It's 5%. It's higher than just buying a built property, which is 0%. So again, when you factor this kind of stuff in, you can start to understand human beings. It's really about them. What can they tolerate? What can they put up with? Now, going back to my buyer's agent friend, who probably thought from a buyer's perspective doing a very, very good job, the investor will struggle with that asset at $620,000 with the 6% plus yield. Why? The market risk, it was in Melbourne, 10%. Property cost risk is at least 30% on what you would have to factor in over a 10-year period. And the delivery risk is, because it needs a renovation, and that's one of the hardest things to do, is 12%. So the investor is taking on a property with a risk profile of 52%. It's 52%, 48% of a chance of working out, 52%. It's a coin toss. This property is a coin toss, whether it's going to work out over the long term. Remember, we're measuring the long-term result here. Now, we don't know if this investor wants to try and flip this property in 6 months, and I don't know. We don't know. But when we're measuring it over the long term, we can tell that that property has a pretty flawed risk profile. And I've been here and done this myself. Like, I've got the lashes on the back from putting an investment very similar together, where it was basically in a subpar market, in the Townsville market. The risk adjustment for Townsville is 20%. Property had a lot of cost risks associated, 30%, and the delivery risk of doing a renovation was 12%. I put together a deal for an investor with the 62% risk profile when I was much younger, and it didn't work out for that investor. They did their dough, and I was responsible for that, and they were responsible for that. We were a team trying to do something together, and it failed. So why do I know about this stuff? Is because I have seen it firsthand. You've got to factor in costs. You've got to factor in costs. So what is long-term investment? It's embedding a low-risk strategy. It's embedding a low-risk strategy. And that's because behavioral finance is at the key of sociology, psychology, and money. That's it. It's you. Real estate is reliable. People are not. If I pass on to you a real estate which is going to have a 50% chance of a loss, psychologically, that will break a person. It will break a person. I've seen it happen. I know it happens. And so certainly when I look at real estate and the types of real estate I tend to put together, it has a typical risk profile of around 15 to 20%. 15 to 20%. And it's in most people's ability to manage. Remember, psychologists estimate 5 to 25%. 5% people don't even, shouldn't even be investing. People who, have a meltdown, over the littlest thing probably shouldn't be investing. But for most people, they can tolerate 15%. I haven't met many people that can tolerate 30%, 40% of a risk profile. So we've got to think about the Kelly criteria, define the deal, estimate the outcomes, apply the formula, decide if you're going to do it, and then you've got to implement the strategy into your life. That's the point of the conversation. And so short-sighted investing, I see it a lot. It's ignoring market risk. It's focusing only on perceived gains, not perceived losses. It's neglecting the Kelly equation, which is maintenance costs and risk adjustment. It's not knowing your stress metric and percentage. What percentage are you? Are you a high-risk person? Are you a low-risk person? Are you a medium-risk person? If you're a high-risk person, you could probably stretch your risk profile to 40%. If you're a medium-risk person, probably out of 15 or 20%. If you're a very low risk person, maybe real estate's probably not even the sport for you. So short-sighted investment, ignoring market risk, focusing only on the upside, neglecting maintenance costs to allow you to go forward, not knowing your stress percentage, and underestimating sustainable holding costs, power, compounding returns, and more time in the market, and that creates more wealth. So that's how it works, folks. Hopefully that was helpful. Thanks for tuning in, by the way. And I'll catch you on the next show when we talk more real estate. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.